Hey guys, it's Downtown Josh Brown. Welcome back to an all-new edition of What Are Your Thoughts? I'm here with Michael Batnick. Michael doesn't know what I'm going to ask him, and I don't know what he's going to ask me. Play along with us in the comments below. Tell us your thoughts. Let's get into it. All right, Mike, I'm going first. I want to talk about your post-market surprises and just this idea that you should expect the unexpected. I was curious about your thoughts when you went through the research. Did you find what you were expecting? Because while you point out that over every 10-year rolling period throughout history, you had a 95% chance at seeing a positive return, the ranges were all over the place. Is that what you expected to see? And did anything jump out at you?
Yeah, I wasn't surprised at that. I guess what surprised me was how shallow the lower bound was. I wasn't really thinking about what it was going to be, but it was negative 5% annualized for 10 years, which is...
That's the worst that you saw in the research.
Yeah, which is bad. That means you're down quite a bit of money. More than cut in half. But I guess I thought it would be worse than that. And the point that I was really getting at was the limits of using market history as a guide that is firmly planted or baked in cement for the future. Because worst case, we don't know what the worst case is. We know what the historical worst case is. But shit happens all the time that has never happened before. And I think you just got to be prepared for a wide range of outcomes, which is not terribly helpful. But for example, stocks never fell 30% in 5 weeks. So if you were looking at history, what are the odds of that happening? You would say 0. And then it happened.
We don't have enough history to really calculate odds.
And then in terms of like market regimes, when you're looking at non-overlapping 10-year periods, you don't have a whole lot of history. It's not like we've got 1,000 years where we say, okay, we've seen this before, we've seen that before. Like we've seen it all. We haven't seen it all.
Right. So you can't say, okay, here's what happened the last 50 times the market fell 30% in 5 weeks.
Right.
Even then, I don't think you would be doing science. It's still interpretation. But the reason why I think this is so helpful is because when you're building a portfolio or you're recommending a portfolio to an investor, having that information in front of them so that they understand why you're not betting on one particular outcome. So like you sit with a client, they're like, well, I'm really worried about inflation. Build me a portfolio that's going to factor in that and get rid of my bonds. Or I really think there's going to be another bear market in the fall when COVID comes back or whatever. Their reasons are fine, but then just showing them, look, that could happen. But then here are all these other things that statistically could also happen. And we have to plan for everything. We can't place one bet and hope to get it right. Even if we get it right once, can we do that all the time?
Well, I
don't know that.
When you're looking at market history, looking at the range of outcomes as opposed to what the average is a much more useful exercise, I think. That's the point that I was driving at.
I totally agree. I thought it was a great post. What do you got?
All right. I want to talk about an idea that I've been kicking around that I'm going to call the investor's dilemma. And I think that everybody goes through this at some point in their life where you have people that just are always...
Are you okay?
I'm great. Thank you.
Going through something? Okay.
Where you have people that are always dismissive of the next idea, and then you have people that are always chasing the hot idea. So on the one hand, you don't want to be like the investor who was just completely dismissive of the internet in 1998. You don't want to be that person. On the other hand, you definitely don't want to be the investor that bought telecom stocks in December of 1999. So How do you balance those two competing ideas, which whether it's cryptocurrency or the hot stocks today or whatever, I mean, there's always something.
Can I be honest with you? There's a really simple answer. Stop loss. You seem stunned. Why isn't that the answer?
Well, because
you say to yourself,
I don't think that's, I mean, that's one answer. I don't think it's a great answer. You get stopped out a million times.
It's the easiest answer. Right. So I think it's the easiest answer. You say to yourself, all right, Shopify, I get it. There are 50 million small businesses in America and Canada. Forget about Europe, Asia. There are 50 million small businesses, and they all want to fight back against Amazon, but they can't obviously do it. So here comes this company that is offering logistics, shipping, fulfillment, the shopping cart on the website, the payment gateway, the email back and forth with customers. Like, this company is going to arm tens of millions of businesses who want to sell and have a competitive e-commerce situation compared to the big guys. This is a brilliant idea. However, it's 40 times sales, whatever. So you say to yourself, I don't want to dismiss that this company has the ability to be enormous and extremely important in the economy of the future. So I want to be in it. But I'm aware that A, I'm overpaying like everyone else is, and B, this could be a bubble and I could be buying in the ninth inning. So how do you balance that? Well, you get long. Position sizing is another thing that you can consider, but just use a stop. And if you are the last idiot to buy it, which is going to happen to you in your life, the market will tell you. Now,
counterpoint.
You get stopped out, then you have a harder decision. All right, now's the time to buy it. Like, and you could, to your point, you could do that the whole way down.
No.
I think
you could do that the whole way up. So the counter is that all of these best stocks, I mean, forget about cutting half. If a stop loss is useless if you set it down 50% below, but
right,
it happens multiple times though. So that's the thing. So I don't know that a stop loss is the right answer. It's an answer. I think it's maybe better than nothing, but these things correct all the time to varying degrees. So what's the right amount?
So I've been in NVIDIA since 2015, and I think I've been cut in half maybe twice, but I've seen more than a dozen 20% drawdowns in that stock.
Right. So stop losses would have killed you.
The way I thought about NVIDIA was that I'm going to take full risk here because I don't want to get stopped out because I had that conviction. So it wasn't a dilemma for me. It doesn't mean that I had to have been right. Like, I'm just saying in hindsight, this was one that worked. There were other things I wrote down that never recovered. But I think, like, at the end of the day, that's why there's risk involved. The only reason why you could own a stock that goes up 4x or 5x is because you're willing to sit through a 50% drawdown. So the dilemma might just be a time frame thing and a style thing. If you're a trader and you want to be in these names, I think you need a stop loss. And if you're an investor, I think you need to say, how much risk am I willing to take? And then size your position accordingly. But I don't think there's ever like an answer. I also think people change depending on where they are in their lives and what experiences they've had. And, you know, as every investor matures, they start to realize, okay, this would be great if I own this sector and I'm right and it really works out, but the consequences would be worse if I'm wrong. So I'm just going to watch it happen. That's a mature attitude. Maybe it's not the secret to huge returns to pass on everything, but I don't think there's anything wrong with that either. Do you?
I just think it's a difficult question.
I agree. Listen, I wish I had the answer. In a similar vein, I wanted to ask you about, I have this thing where I feel like the argument of fundamentals versus technicals is wrong. I think right now the real argument is technicals versus macro. And I jotted down some notes about what I was thinking. I might write about this, but I was saying, like, everyone always compares technicals to fundamentals. But it seems to me that if you look at technicals versus macro, most of the people who study and follow macro data and are really into like all of these economic reports and the prices of currencies and oil, it just seems to me like they've been on the wrong side of the market for a really long time. I'm sure I'm overgeneralizing and that doesn't apply to everyone. But what we've seen in the last 5-10 years, when the economic data starts slowing down, stocks start rallying. And when the economic data starts to recover, all we end up with is lower bond yields. Like, these things are broken. They're not working together. We had deflation fears in 2015, 2016. All that did was put a floor in for the price of gold. So to me, it seems like the macro stuff is almost all counterintuitive, whereas technical literally is going with where prices are headed and not trying to fade that. What's your take on macro versus technicals?
Well, I think the reason why technicals get compared to fundamentals is because you're talking usually about where do I start? I want to learn about investing. Where do I start? Nobody starts with macro. There's too much to swallow, too much to wrap your arms around.
Yeah.
So I think that a lot of the macro people use technicals.
Okay, that's a fair point. But the people that are coming up with an opinion on the economy and then distilling that down into an idea about what the stock market's going to do are not using technicals.
But how could you do macro without looking at charts?
If you are going to trade on macro, do you have to have the belief, the opposite of being a technician? Do you have to so a technician would say the market is smart. Market knows where it's going, and the trend is the trend. And then they're looking for divergences where opinions are changing and price still hasn't yet, or vice versa. The macro person is basically saying everyone in the world is an idiot if they're a contrarian. Everyone in the world is wrong, and my opinion of what's about to happen in the world is right. And that's almost the opposite of technical analysis.
But this is very specific. I think you're talking about the macro people that sell newsletters, because that's one of the appeals. So I don't know that macro hedge funds are actually think that everyone's an idiot. I think that some of the stuff that we read from people that are selling us a newsletter service are of that vein, because they have to sell something.
That's fair. So you're saying part of the appeal of a newsletter is somebody telling you why you're going to know something that everyone else doesn't know.
Huge.
Right. And a technician is not going there. A technician is basically saying, here's what's happening. We either think it's going to continue to happen, or there's a divergence and we think it's about to change.
All right,
it's very different to me.
I want to ask you about something that I think is remarkable. This is from the vice president of Exxon. Exxon has a long history of providing a reliable and growing dividend. A large portion of our shareholder base has come to view that dividend as a source of stability in their income, and we take that very seriously. So Exxon is currently yielding around 8%. They've paid a dividend for, I think, almost 40 years. And what they're doing is they're suspending the matching program to their 401k, which matches employee contributions who contribute at least 6% of their salary with a 7% company contribution. So they're suspending their 401k match to preserve their dividend. Thoughts?
Are they lowering the dividend?
I don't believe so.
So I think like dividends can be a trap for corporations, and you'll notice like Berkshire Hathaway never paid a dividend, and some of the best performing stocks of all time weren't. I mean, they might have had small dividends, but they weren't like, hey, we're a dividend stock, buy us for that reason.
Altria, Procter and Gamble, there's some of that are on that list.
Sure. I think what happens though is you get trapped, and like you could have a revolt on your hands, because there are shareholders that like set their watch by the fact that every quarter, 4 times a year, they're going to get this cash payment. And I here's what I would say though. I would say modern financial advisors who are building income portfolios, I think, are starting to realize that they have to just focus on total return. And if you have to help a retiree fund their retirement with cash from proceeds of a sale, rather than like go all in on the highest, riskiest dividends, I think it's more explicable to clients today. I think they understand the difference. And then the other thing with dividends is, obviously we know that the tax consequences suck and really aren't helping anyone, especially when the choice is dividends versus buybacks. But I almost feel like there is a portion of the population that are religious about it. Like it's like a sacred thing. Like what do you mean you're cutting the dividend, or you're not going to pay the dividend? So I do think Exxon has a point. I mean, it's ugly to take money from employees to prioritize shareholders in a time like this, but I kind of understand it. They have to manage for their shareholders at the end of the day. But it's a trap. And I'd be interested to see if they can maintain, is 8% right now? I'd be interested to see if they can maintain that for much longer without some change in the dynamics of the oil industry. I bet you they can't. And last thing I would say, when I started in the industry, there was still like 15 or 20 steel stocks. Like Bethlehem Steel was still trading, and Ishpat Steel, and all these companies that don't exist anymore. And they were dividend stocks. Like steel companies were similar to oil companies. They were reliably paying dividends. That's not a thing that exists anymore. So I think eventually, if you're a commodity-based, even if you're a blue chip, like reality comes for you. And that doesn't seem like something that I would want to bet on, that dividend. Because who knows what they have to cut next to keep it going. Like what would you say if you owned
borrow
Exxon?
or adding on more debt to keep it going?
They could do that very, very inexpensively now. A lot of firms are doing that. What would you say if you were an Exxon shareholder and they said they were cutting capex by 30%, but preserving the dividend? You would be like, well, how are you going to pay the dividend 3 years from now? With no new discoveries and no new production. So I'm not a fan of dividend targeted investing. I'm fine with dividend stocks. I reinvest them in my own portfolio, perfectly fine. But owning something just because it's a high yield, especially in a declining industry like fossil fuels, it seems like more of a headache than it's worth as an investor.
So you'd much rather take like 4% from Coke or 3% from Verizon or whatever.
Yeah, and that doesn't mean that those are nothing's guaranteed, right? Actually, if I'm building a portfolio right now with just yield in mind, like if that's just what I'm doing, I'm probably buying the preferred shares of banks. I think they've turned the banks into quasi-regulated utilities. Their balance sheets have never been better. They'll definitely be challenged in this recession to some extent, but those preferred yields to me are a safer bet than an oil dividend, even in the biggest oil company in the world. One of the biggest oil companies in the world.
I just buy Tesla and sell one share every day for income, or fractional
Tesla
share.
Dividend?
A fraction
Is
of a
that
share.
Is that a Tesla dividend? Peel off a share every quarter?
It's yielding 150%. It's incredible.
Awesome. I wanted to ask you about Triple Qs versus Spider. Did you see Ben on Bob Pisani's CNBC show yesterday?
I did, but I had him on mute. No, I'm just kidding.
It was only a phoner, so that wouldn't have worked out well. So Ben called into Bob Pisani's show, and our boy Tom Lydon was on there, and they were talking about flows this year, and it looks like it's going to be another record-breaking year for ETF flows. Not a surprise, but this was surprising. $12 billion in net new money came into the Qs, while $23 billion left the SPY.
That's not surprising.
So, it's not. Well, I guess knowing investor behavior, it shouldn't be. But the Qs are like the new spiders.
Well, what about the other S&P ETFs? Because I think that SPY has been having outflows. Like IVV is probably past it, and
VOO.
And VOO. So I would be curious to see what the flows are. I think that might be an SPY specific story.
What's the problem with it? 4 basis points is too much?
No, I think
people need to pay one.
I think it's 9 basis.
How much is it?
I think it's 9 basis points, which is hardly backbreaking, but
What can you buy IVV for?
I think 4. I think
Right,
I think VOO is 3 or 4. So I think that's more of a State Street story.
So on $10 billion, that's kind of a big deal, but on $1 million, probably not a big deal.
No, it's effectively $0.
So I do think though that the Qs are becoming like a new S&P for certain investors. And you just say like, I just want the growth segment of the market, and I'm an indexer. I just don't want a portfolio filled with oil stocks and banks because they never do anything to the upside, and they only hurt the portfolio in a down market. I think that's an attitude that people are starting to adopt, and it's all recency bias. But whatever, like I understand it. If you've been in the market 5 years, that's all you've ever seen. 117 billion into fixed income ETFs. What the hell are these people chasing?
Price appreciation.
On what? They're buying corporate bonds. They're buying treasuries. They're buying treasuries at no yield. Like is that a fear trade?
Well, what if this is front running the Fed? Like there was monster flows into HYG relative to the total size of the fund. I think 60% of the total assets of the fund have come in the last 12 months. So I think a lot of this is Fed driven.
So the Fed is buying LQD. The Fed is buying investment grade corporate for some reason that I can't really understand.
And they're not buying a little bit.
No, it doesn't move the needle. Why bother? So for some reason I can't understand, the Fed is buying the bonds of companies that look like they're well financed for the next 100 years.
Just shut up and buy. Stop asking questions.
I don't really. And then all right, so you're not surprised at any of the flow data?
Not really. What's interesting is that GLD has taken in the most assets over the last 12 months. And I did this thing while we're talking about it. So I looked at the total assets in GLD and IAU, the two biggest gold-backed ETFs, today compared to 2011 at the peak of their price. So in 2011, if you remember, I know you remember, GLD passed SPY and it was the biggest ETF in the world. So right now,
I wrote a
GLD.
post about it that week.
Did you? Oh yeah, you did.
Yeah.
We looked at that the other day. GLD and IAU are 35% bigger in terms of total assets than they were at the peak in 2011. However, if you could, what I missed was, and I forget who tweeted this, maybe it was Balchunas. If you look at those two relative to the rest of the ETF market, they've shrunk because the ETF market has grown so much. So right now they're 2.5% of the total ETF market. In 2011, they were 10% of the market.
Wow. And the minor ETF is so tiny, it's not
tiny.
even worth
All
mentioning.
right, last thing I want to talk about. So we're seeing a rotation. Everybody's talking about it. The beaten up stocks, the reopening trade, basically. So casinos, airlines, cruises, transports, small relative to large. Tech is finally pulling back. The stay-at-home stocks, Peloton, Wayfair, you know the names. Does this have legs, or is this going to fizzle out in 3 days?
Do you remember what happened in the middle of May through the middle
Oh,
of
I
June?
remember. It fizzled. It didn't fizzle out. It crashed.
It crashed.
Yeah.
It was an amazing reversion trade
Yep,
though.
yep.
Like if you were smart enough to have seen it coming. I don't know. I own Berkshire Hathaway. I saw the stock run. It was like 189. It ran up to 200 into the earnings, and now it's like 212 or whatever it is. When you look at that company and its earnings and what's going on in their businesses, pretty much everything sucks, with the exception of the fact that they're the largest shareholder.
Forget
in
about
Apple.
that. Let's just talk about price for a second. So like if you look at small relative to large, it's got legs. And if you look at small value relative to large, it looks like it is really trying to bottom.
Well, if you think there's a vaccine coming this fall before the election, which is what I think, then you could probably continue to make money in those stocks. But there will be scary news along the way, and there will be delays and delays in approval and all these things, and they'll probably hit those stocks again. So I wouldn't be like, oh my God, I have to get into a cruise line now. And I could be wrong about that. But we've had these profit-taking moments. I will say that a couple of the high-flying tech names
Like
have
what?
gotten really whacked.
DocuSign, Datadog.
Oh, no. Here's one I wanted to mention. Fastly.
What's that?
So FSLY is like one of the poster children
Yikes.
for like this whole cloud computing thing.
Does not look
at the
healthy.
chart on this.
Yeah, it looks terrible.
It's like the worst thing I've ever seen. So maybe something has changed.
Well, it went from 20 to 120, so
No, I understand that, but that price action tells
looks
you
terrible. It looks terrible.
there are people that are leaving that stock and never coming back.
it looks terrible.
So, and it's on an earnings report. It's fundamental. It's not a rogue wave that came out of nowhere.
It's macro.
The company couldn't match the expectations. It's macro. All right. Let us know what you guys think of all the topics we discussed. As I said, we love your comments and feedback. Go ahead and subscribe to the channel if you haven't already. Give us a like if you like what we're doing here. We will be back with What Are Your Thoughts in 2 weeks. Thank you guys so much for all the subscriptions and for all the likes. We really appreciated all the feedback. Michael and I will be seeing you very soon.